Okay, we move on to session 9, which is Aginvestment. For this session, I'll be handing over to Michael Whitehead, Head of Agribusiness Insights, ANZ, who will facilitate this session on Aginvestment. Michael will take us to afternoon tea. Very briefly, in his current role, Michael focuses on mapping industry-based trends and analysing the impact of these sectoral changes and dynamics on stakeholders across the agribusiness sector. Michael has featured widely in global media outlets, including CNBC, the Financial Times, and the Wall Street Journal. He has a background in agricultural production and consulting, particularly in Australia and China. Michael, all yours. Keep that. I think your guest.
Cool. You can take that back. Thank you very much. The ANZ Greener Pastures report that Mr. Fitzgibbon quoted from, I love that, the fact that we wrote that in 2012 and people are still using it. If only we could get that kind of mileage out of cars or tractors or anything else. Thank you very much for staying for this panel, the Ag Investing one. Look, I won't make them stand there. Invite the other speakers up onto the stage to take a seat. Adrian Redlich from Merricks Capital and Philip Jarvis from Direct Agriculture, whom I will introduce in a moment. You've seen on the program that this is the ag investing side. Now, you all, by the looks of your grizzled faces, are conference veterans. You've all seen ag investing panels, and what you've come to expect is that we will all have a different product or fund to try and sell you. We will tell you a pack of lies about how good our returns are going to be. We will patronise you by telling you about supply and demand for wheat and other things in some way, and you won't invest in anything we do. If that's what you want, unfortunately, we're going to disappoint you this afternoon. A, by not doing that, because in a way, none of us have anything to sell you. And secondly, we're going to disappoint you because with that point made earlier in the day that the panels later this afternoon have gin and whiskey as well, and we have nothing like that, but we do have coffee at the end of the half hour. So in terms of what we want to cover in this particular session between the three of us, and I'm half serious when I talk about the fact that ag investing panels here and around the world often do that. They look at things in terms of this fund or that fund or the other fund. Knowing these other two gentlemen, we want to take it from three quite different ways. I'll present and Adrian will present, and then Phil will discuss another particular area as well. What I'm going to start talking about in this brief presentation will be particularly at let's say the lower end of ag investment. In terms of where the returns are, it's from a particular paper which we'll be releasing this weekend at Sheep Venture in Hamilton, if anybody will be in Hamilton, that looks at comparing mixed farms with cropping operations, sheep operations, beef operations, where the returns are, where the volatility is, where the correlation is. And one of the reasons for doing that is that while in the ag investment space there is so much attention from wealth managers, from super funds, from ultra high net worth individuals, there is also a huge amount of attention from that biggest driver of agricultural growth in Australia, and that is buying the neighbour. That is one point. When you expand your strategy, whether you stay in cropping, whether you stay in beef, or you look to diversify. And the other big area, and I get this living in Melbourne these days, despite being a Western Victorian sheep farmer at heart, is that the amount of people who are keen to be part of this space, Melbourne-based medium-level investors, what you'd call sort of at the medium level of the wealth range, who are keen to get into agriculture in some way, who are keen to get into farming. And when I meet with them sometimes, they literally say, where do I start? What do I look at? You tell me where to go. And they're keen to look at where those returns are going to be. So we'll look at that in a few details here, and then quickly finish with a cliche, a couple of cliches about what the New York capital is looking at the moment. One particular way, which is quite different from the rest of the presentation, you're all country people, and those friends of yours in the city who said to you about 5 years ago, I want to get into this ag thing that you're doing, into my self-managed super fund, what should I be investing in? And whether you told them to get into Murray Goulburn or Elders or AACO or Treasury Wines, whatever it was, had they got into a particular basket of food, beverage and agri shares, compared to some of those other industries there. And Adrian's far more of an expert in this world than I am. But there's just a broad example of where some of the returns have been over a 1, 5 year and 10 year period in those broad categories in terms of shares. Had they followed your advice, by the looks of that, then they would be thanking you. Let's look at things in terms of going back to the main point I talked about. Where are some of the returns going to be and the volatility going to be in particular operations? And we're going to break it down. And our particular paper that we've written is on mixed farming. And we came back to that because for all of us in the agricultural sector, we're all fascinating observers of our industry. And we follow very much a trend and where things are going. Where are we at the moment? Are we being encouraged to have diversified operations, our cropping, our beef, our sheep part of our own individual operation, or are we being encouraged to specialise in what we do, become better beef growers, become better wheat growers, and go down that path? And it becomes part of a lot of our planning decisions. If you look at where Australia is going, and we've used some ABARES data for some of this and ABS data for others as well, if you look at where things are going in general as far as mixed farming, your mixed operations versus the other two, it is intriguing to see that the trend towards cropping over the last 30 years has seen mixed farming and the number of mixed farming operations fall by 30% over the last 30 years, which is a sign that people have increasingly chosen to specialise, which is interesting, which goes contrary to some of the some people who would observe the industry. In terms of Australian total farms by sector and a percentage of all farms and taken by sector, and I will qualify with some of these, when you use ABS data of farms, it does bring it down to some very small operations which can skew things at times. And that's sometimes the reason why some of it may not look like you expect it to do. The total number of mixed farms over the last 30 years has dropped by 60% on pure definitions. Now that's partly a result of consolidation. The overall percentage drop has been less than that. If you look at the fact that cropping's up and cropping has continued to climb as a percentage of overall farming operations in Australia, driven by the labour availability. An interesting one from an economics point of view and a farming point of view is obviously wool operations went down after the wool price crash of the 1990s. In terms of correlations, the wool versus wheat correlation is one of the closest, inverse correlations, one of the closest in agriculture. Where wool remains an interesting exception to most things in terms of supply and demand is that the higher and higher the price goes and the demand grows, the supply does not react. Will the supply react? How will the supply react? Not for a grains conference, but fascinating to see in terms of investment and growth. The other thing that's changed some of this as well is, as I say, that structural change in Australian agriculture, that whole by the neighbour concept. And if we look in terms of the average size of an operation in Australia, mixed farms now take up about 20% of Australian acreage, excuse me, or about 6% of all Australian land. They're the second largest number of enterprises behind beef. Interestingly, mixed farms are down. Few West Australians in West Australia as you become sheep and cropping specialists, but growing in New South Wales and South Australia. So let's look at it in terms of a couple of financial measures and volatility measures. Let's start with the commodity price. It's not the profitability price, but let's start by looking at it in terms of commodity price. Now, managing volatility is obviously, from an investment side, whether it's your own operation or an outside investor, one of the things that becomes a benefit if you can manage it. And what we have here, and you can see wheat prices, beef prices, lamb prices and wool prices since about 1998. Volatility is not always a negative, particularly if it's upward volatility, but negative volatility can get your own operation, your investment right off track and potentially permanently. So diversification, obviously, in agriculture, in your operation, is going to be a way to reduce that volatility. So let's look at where the correlations are and where that diversification can happen. Now, as you know, positive correlation is where two things move together. So once you get to one, they're moving together perfectly. Negative one is when they're moving opposite. So what are the ones that jump out in terms of the commodity returns that move together the most? The one that jumps out the most there is that beef and lamb move together. When beef prices move, lamb prices move pretty closely together. They're substitutes for each other. If you go to the supermarket and you don't want one, you tend to buy the other. Your Chinese importer, if they don't want one, they want the other, which explains why they're particularly moving at that rate. My taxi driver on the way in this morning, and all taxi drivers are an economic experiment. If you're an economist, find out what they're eating, what they're buying. He's not buying lamb as much for his family because it's hit $30 a kilo in the supermarket. Message out there for the sheep industry, they're going to lose the taxi driver market. So that's what's moving together. What's moving separately in this? And if you look at the biggest one there, a bigger negative correlation than the positive one, and that is wheat and beef. And the fact that when one moves in one way, the other is almost always, over that period of about since 2012, moving the other direction. Why is that happening? Now we know some of the reasons why we think that would be happening. That if whether it's weather-based as well, whether it's feed requirements, whether if people are offloading cattle, it's seasonal. But it's interesting to see that's happening. What does that mean for an individual operation? On its own, based on just commodity prices, which is a basic alone, that alone says that will in some way mitigate your risk because you will have one working as a counter to the other. It's also interesting to note with those two as well, and here is a quick ad. If you go to the ANZ stand out there and read our latest wheat note as well, one of the interesting things that comes up if you look at stats over the last 30 years, here's a numbers thing for the numbers geeks out there. Every time wheat production has gone down in Australia by around 25% in the last 20 to 30 years, every year that it's done that, exports have gone down at almost the same rate. But every year that that's happened, domestic consumption has gone up 4 times the average. The average increase in domestic consumption is 3%. Every time production exports go up, go down, domestic consumption goes up by 12%. An example of where that feed is needed and what the pressure is going to be on prices. So that's where some of the correlations are in there, and that's what that diversification could mean in a mixed farm operation between wheat and beef. Now, let's look at different farm scales and where some of the volatility is. Volatility, let's go away from commodity prices and look at it in terms of farm receipts, farm costs, and also profit as well, taken from this ABARES data. And we're looking at, with receipts and costs, a volatility or a variability from the trend, and in terms of the profit, a variability from the average. And what this is showing us is that receipts particularly move around what's coming in, what you're getting, due to market conditions. A lot of that largely is beyond your control. That's what you're getting out there. Your costs are moving, not entirely within your control, but far more so due to farm management. And cost volatility for good operators is something they are going to really have room for improvement if they want to improve their operations. So what's the result? If you look across at all of those, and particularly which are the most volatile in terms of profitability, you'll see, and what we have here on this slide is all farm sizes there, and then the ones with turnover of less than 500 grand. On the next slide, we'll show the bigger ones. You'll see that the volatility for mixed farming is less for the larger scale mixed ones that we'll get to than it is for the small ones. Small mixed scale farms are very volatile. If you look in terms of their profit, high volatility compared to other operations in terms of the small ones. And if we get onto the next slides, in terms of the medium ones. If you look down the right-hand column, you'll see that high volatility for mixed farms compared to everything else. Why is that happening? Why are the larger mixed farm operations some of the least volatile in profitability compared to all broadacre, wheat, sheep and beef? Is it because if you're running a large operation, you are more likely to be an innovative operator, you are more likely to know how to structure your operation a lot better? And by the way, anybody taking photos of these, this will be out on the weekend, it'll be online, and happy to email you one shortly as well. Why is that happening? What's meaning that? Or is it another feature that increasingly a mixed operation will be geographically spread, so that will diversify risk a bit more? And it's interesting when you compare that to the volatility, compared to wheat, compared to sheep, compared to beef. One other thing that jumped out from those stats in terms of volatility in terms of returns and profitability, was if you compare higher volatile receipts and costs with beef And if you look at beef down the very bottom, 11 and 11, going to about 24% volatility of profit. And then you compare the lower volatility of wheat in terms of receipts and costs, you're still getting the same volatility in profit. It shows that the two don't necessarily impact that profit variability. And why is that that way over the years? The one other way of looking at it is in terms of to look at where for each of these things, we see wheat up there in the top right-hand corner, to track things on a standard deviation away from in terms of their volatility and what their average returns are on the bottom axis. And what this shows us is that, in a way, mixed farming operations sit in a sweet spot. They have high mean returns, but a relatively similar volatility to sheep and beef as well. If we look at where cropping sits, it sits with higher returns, but much greater volatility, based over that period from about 27 to 2017. The final slide in terms of these ones is to look at where the absolute returns have been in terms of these operations over the 1-year period, the 5-year period, and the 10-year period. And the 10-year period I always find interesting because in the investment world, for people seeking to get into a fund which will largely have that time frame, that may be the period of time they're most looking at. And what is intriguing to see here, that in terms of absolute returns, mixed farming over those periods of time continues to come across without capital appreciation or putting the capital appreciation on top of that as greater returns than sheep or sheep beef or beef operations, but still over those period of times are falling behind cropping. The interesting thing to go forward with now, not in today's talk, and we could do it in questioning and we could do it in further pieces of work, is how does this pan out for the future? And what are the returns likely to be across these sectors as people look to further investments going forward? Before I finally hand over to Adrian, I'd just like to turn back to one other piece of an agri-investment panel that one needs to talk about, and that's the offshore capital one. And in a quick piece of work at 2 o'clock in the morning when I'd finished correcting some things in that, I thought, what's New York capital talking about? So I rang some New York capital providers on Wall Street and Park Avenue, and Phil knows some of my friends there as well. And I said, what is occupying your mind, you completely non-agricultural, incredibly large capital providers out of Wall Street, the ones who attend the Global Ag Investing Conference, semi-seriously, but what is the thing that is occupying your mind when it comes to agri-investments from where you sit right now? And what the first one said was sustainability, sustainability. And his quote was, I don't know where this came from. 10 years ago, I didn't have to care about a sustainability clause or part of any agri-investment, and now it is compulsory that that is in some way involved in any agri-investment in the US or Australia that I become part of. The second part, and it's been talked about very much in an earlier panel today, is on ag tech. And when that level of capital looks to an investment, as we say, in Australian agriculture or in other parts, it wants to see where the technological component to integrate with its business is going to be. And the third part is on traceability, absolutely on traceability and how that's going to feed back to the consumer. And the final two things, and the Shadow Minister talked about it before, where's the competition? What are the new things that are distracting them? Where do they see the future of agriculture? The first one is not your paddocks going out, it's what's going up. They are all about vertical agriculture growing in Brooklyn or Singapore or Werribee, which is closer to the cities, which is able to grow without more soil and will feed people far closer to them. Huge attention on that. And the second one, which terrifies the hell out of a lot of the beef growers anywhere from Warrnambool up to Rockhampton, is the fact that the big city capital is looking at this 3D meat very seriously. And to finish off, the last time I left the Global Ag Investing Conference in New York a couple of months ago, went upstate New York into good old boy country onto a friend's place out in the boondocks, went into the local Walmart to go shopping. You can buy your guns, you can buy your bullets, you can buy your gear, and then out in good old blue America, there's a very large fake meat section even in Walmart. So it's coming, and it's something that perhaps the cropping industry should capitalise on. On that, I'm going to hand over to Adrian to take the panel on to the next phase. Thank you.
Just wait for the slides to come up momentarily. Here we go. So I thought I'd focus on a somewhat narrow area of investing in ag today, as far as most people are concerned, and that's the provision of finance. So it's not necessarily buying farms or assets, but providing credit to the sector as a whole. It's something which I think is becoming much more topical across the nation, not just relation to agriculture, but every form of business, as the banking system comes under somewhat a little more pressure to provide capital, whether it be through the changing regulatory environment or through royal commissions or the like. And so what that has led to for us as an investment industry is the opportunity to provide finance in lots of different forms. That's not necessarily competing with the local farmer to go and buy the farm, but to work with the farmers, logistic providers, food processors and others to provide finance. With the capital markets, sorry, I'm just having a little trouble here with the... There we go. The capital markets tend to send us messages. They send high returns tend to tell us where there's a need as an investment community to provide capital. And I would say whilst money, as we all know, is in theory very cheap, it's not always that easy to get hold of from the banks these days or from other providers. And I think that is something that's changed quite dramatically over the last couple of years. And so we have a situation where there's the haves and the have-nots. And of course, the have-nots find it usually at a time when their business is under pressure, where they're suffering from a drought. No one wants to lend to them or no one wants to provide capital. Combined with an environment where we have a Royal Commission that obviously has got a lot of press from a fairly small segment of the Commission relating to agriculture, banks are somewhat gun-shy in terms of how much credit they provide. They do, I believe, want to support farmers as a general rule, but it's obviously become problematic to them because in large part, the nature of a bank balance sheet is not well suited to a cyclical industry. They're not necessarily always the best partner when you're in a business, as we know that not every year we generate profits. It can be it's very much a boom-bust cycle that we all have to look over the long period of time, whether it be in grains or other form of agriculture. And so we're finding the opportunity, and I think it's us and the entire sector, to provide non-traditional sources of capital to the ag sector and to the grain sector in particular. The other thing we know is an investment opportunity, running farms from Collins Street or from Fifth Avenue, as we discussed, it's not that easy, and I'm not sure that farming from big conglomerates or from funds is necessarily going to be the lowest quartile producer. But one thing that is clearly an option is to provide an alternative to the others who sit in Pitt Street or Collins Street, and that's the bank. So to provide alternate opportunity to fund farmers, to fund the sector, whether it be logistics or other area. And so the new credit environment is providing us with that opportunity. And I think at the heart of this is that banks are inherently conservative partners. They have to be. They hold all of our deposits and they leverage their equity somewhat on average 17 times in providing you with finance. By contrast, our core investors who are super funds or pension funds from offshore and individuals in higher net worth, what we're tending to do is provide finance to people in the form of, it's equity in the sense people invest $1 in the fund, $1 gets lent, it's not leveraged. And so what that allows is a much more liberal view to risk-taking and partnership. And so I think this is an evolution, and it's an evolution I think that's been forced as a monopoly in the banking system retreats, and it's giving the wider finance sector the opportunity to step forward, provide higher risk capital that might take more risk, is more flexible in the sense it doesn't necessarily need an interest rate paid every year. It might want a higher return, but it's going to ebb and flow with the natural cycle of what we all do in the farming landscape. So some of the areas where we're providing alternate finance and others, financing of inventory in the grain space alone in 2017, after a huge crop at the end of 16-17, after providing no finance to the space, we financed over 1 million tonnes of wheat for various exporters, farmers, etc., and really stepped into a market where there was obviously a huge crop. There was a lot of pressure on local pricing. Trade houses hadn't had a particularly good period through 2015 and 16. And so the traditional sector being banking and trade houses had somewhat reduced risk limits. The markets were sending us a signal that we needed to provide capital to that sector. Similarly, the financing of farms. In the last few weeks alone, we've refinanced a number of dairy farms. Dairy is obviously coming off the back of a difficult period of time, and we've been able to work with those dairy farmers where we provide interest holidays, if you like. If the dairy price goes higher, we'll charge a higher interest rate. If it goes lower, we won't charge any interest rate. And I think that's the type of thing that equity type investors are happy to look at, alternate ways of participating in rise and fall in commodity prices without necessarily stepping into the role of farmer. Similarly, around trade finance, it's become a bit more challenging for some parts of the banking structure under some of the new rules, and also infrastructure, particularly things like irrigation. We're working with some of the co-ops, as are many others in our space, to provide financing. But a key part of this is really working with the farming community. At the end of the day, the co-ops are controlled by farmers. The irrigation infrastructure needs to be there to solve a long-term solution. And so it needs funding, but it needs funding that's, again, going to ebb and flow with commodity prices and the like. The last area where we're seeing the introduction of alternate financing, the likes of the banks are being forced to pull back from hedging or risk management tools to some degree. And that is really because of the provision of capital, again, under Basel III and Basel IV, is restricting them from providing that capital. And so what I thought I'd give you a few specific examples of opportunities that we've seen in the last 3 weeks as examples, just to give you a little flavour in a sense. Dairy farmers, I mentioned before, lending in the beef sector, cattle prices obviously turned down a little, and there's some reticence at times to lend against cattle. Banks find it very difficult to register a mortgage over cattle and to track them. It's an area which obviously long term that most are excited about in terms of producing protein, export potential and the like, but we also understand obviously it's impacted by drought, it's impacted by very variable pricing and the like, and so having a flexible finance structure where we partner with farmers, abattoirs and exporters is a great opportunity. Export accumulation I talked about previously. Obviously last year was a big year. Obviously we'll have a lot less grain in the country this year and next. I suspect the exporters and the trade houses obviously will be fighting for tonnes, and there'll be no need for and no signal sent to capital market providers to step in and provide finance in this space because it simply won't be needed. Touched on co-ops and funding, but particularly off the Murray, there's a lot of channels, bridges and like around the farms that are deteriorating rapidly. But we obviously have an interesting environment where water price is super high. We're going to be in an environment where we're potentially suffering from a drought, and it's going to become somewhat of a focus on what's the efficiency of those channels and the like, but very difficult for a bank to come and finance that. Who is the co-op? Who stands behind it? It's a loose amalgamation of a group of farmers. So it requires alternate solutions with a long-term view, and not someone that's taking deposits from everyday Australians that need an interest rate on a monthly basis to solve that solution. So the capital market's sending us signals that we should be providing capital and solutions in that space. Similarly, in poultry is a good example. In the last year, we've had one of the major poultry processors pull out of Victoria, focus their operations in New South Wales. They've had certain pressures themselves, which has required them to become more efficient and focused, which is, I think, a good outcome long term, but it's left a lot of poultry farmers in a tough position. Right at the time that they find themselves in that tough position, it's usually banks looking at cash flows saying your cash flows don't stack up, we can't lend against it. Even though we all know, whether it be in the grain industry who provides feed to poultry, or whether it be those investing in poultry, that chicken demand continues to grow much more rapidly than almost any other form of protein. it's an exciting space as much as we get excited by these things in our sector. Yet the lack of finance to build new sheds where the processing facilities stand is something that banks are shying away from, but it's really coming out of the whole construction sector and building sector where there's a scarcity of capital. So one of the things that's flowing over into ag building and infrastructure is the provision of capital to building in general. There's obviously a lot of discussion and talk around housing prices and building boom, but often within that mix is a construction pot of lending that is being somewhat rationed or starved. And so when you look at a poultry shed, and generally these poultry sheds generate 10 or 11 or 12% returns, cash on cash throughout the cycle, they're an exciting opportunity to partner with farmers who have been in the business for a long period of time, looking to take risk and grow. And it's fairly easy to find a long-term solution as long as you take more of an equity style view in partnering with them. Lastly, I'll talk about over-the-counter hedging. One of the areas that we have found ourselves active is providing hedges to cattle producers, the abattoirs, and even the hamburger restaurants in the US. I think one of the areas that we in Australia as a group needs to continue to find better solutions to is hedging. Hedging in the US obviously is much more advanced. It puts the US farmer, whether it be grain grower, beef producer, hog producer, at a huge advantage. Europe certainly has better tools. Australia is very much lacking in this space. And so the capital markets are sending us a signal, partner with people to provide hedging. Obviously we get paid well to provide that risk management, but it gives both financiers and also farmers a lot more certainty around making those capital investments. And so really what I've highlighted is quite a plethora of opportunities today that we're seeing, the ability to make high single digit or even double digit returns from taking a more debt-like position or more banking-like position as a private investor, a non-bank investor. And I think Australia in general is going to see a lot more opportunity in credit, whether it be throughout the economy related to ag in particular. But I would encourage many people who are looking at investment to consider lending to agriculture that has an element of that lending that gives you participation in commodity prices. It allows you to participate in that theme, but also allows us to support the best of breed farmers and the whole supply chain in that process. I think I'll stop there and thank you for the time, and I think we'll hand over.
Okay. I'll just make a few comments. Sorry? Let's make a few comments.
Yeah, absolutely.
I don't have a presentation, I'm not very good at those, but I'll just make a few comments on both Michael and Adrian's presentations, none of which I disagree with, and then I want to refer back to a few things that Joel Fitzgibbon pointed out, sort of in reverse order. The concept of non-traditional lending, alternative banking or shadow banking, that is really a big deal, and we're just on the edge of it. Adrian's at the front of it, but if you go and you look at, again, the capital markets that Michael was referring to, New York, but also London, that really is going to happen, and it is going to be an alternative avenue to secure funding for agricultural enterprises. But the flip side is, while alternative funders are less regulated and are less constrained, it still doesn't stop an individual without the bank actually from continually overly leveraging themselves. But nevertheless, it's going to be a big deal. You've got Insight Investments in London who have got a significant land asset portfolio in Australia. It is likely that before they go a second time on land-rich investments, they're going to go for essentially shadow banking. So that's definitely one to watch. The comment that Adrian made about running farms from Collins Street, Fifth Avenue, St James's Square, that's another real issue that we are seeing. We're seeing there is a natural disconnect between the investment banker in St James's Square and the guys driving the farm, driving the tractors, chasing the cattle. And I think that as the market develops, as we get a bit more sophisticated, you are going to see a lot less of maybe Collins Street, maybe Pitt Street, but you're going to see a lot less of the remote management which you have that disconnect in the chain from the farm guys to the capital. The capital, the investment bankers in London might provide the capital, but at the end of the day, what's between a successful investment and a failed investment is the farm manager. Okay, and so you're going to see a lot more, as what Westchester have done, as what Macquarie have done, is local management teams popping up in regional Australia, in my view. The other one on Adrian's point is capital partnering with operators, providing equity as opposed to debt. That is another, this is one of the things that we do quite a lot, is aligning capital with best of breed operators, joint ventures, co-investments. Again, it is an alternative to bank debt, or indeed alternative funding, but it's an alternative to debt. Again, I see that as very much a way forward, or very much a way that farming families that are capital constrained can actually access not debt, but equity to go and buy the next door farm. It is, however, aligning the interests between a smart-suited investment banker in London or New York or Chicago, or for that matter, Pitt Street or Collins Street. It's a lot harder than it looks or than it sounds, but it is definitely the concept of partnering alongside best-of-breed proven operators is something that is going to grow in my view. On to Michael. I think Michael made a very interesting point, that it's not all about Fifth Avenue, it's not all about ultra-high net worth individuals and billionaires, that actually, there's a lot of people in this room, myself, Michael, Adrian included, who own farms or in some shape or form are financially exposed to the agricultural sector. So from my small little level, all the way up to the billionaires, to the Gina Rineharts, to the private equity in New York, to the sovereign wealth funds out of Riyadh, we are all actually investors. We are all investing in agriculture in some shape or form. We're all extremely different. So the concept of what is an investor, it's not a homogenized group. Every type of investor, every type of capital has got to have different needs, wants and requirements. And that's fundamental to consider when you're looking to attract investment. So just coming finally on to Joel Fitzgibbon's comments. He made the comment that we're at a crossroads. I think we have been at a crossroads from an investment perspective in Australian agriculture for maybe 3 or 4 years. Andrew Robb, before he ended his tenure as Trade and Investment Minister, was palpably getting frustrated that a lot of the FTAs that he had negotiated weren't being capitalised upon by the Australians. And trade and investment, in Andrew's phraseology, it's two sides of the same coin. And I think that Joel made a very significant point about the significant point basically about Foreign Investment Review Board, foreign investment, and the world is watching us, and what are we doing? We're actually seen from a global perspective as not an easy country in which to transact. We're seen to be actually slightly complacent, and that lines in actually with Joe's comments. We're seen from, if we are looking at ourselves as an investor looking into Australia, the waters are rather muddy. Government has a habit, as Joel pointed out, of tinkering with the regulations that regulate investment into this country. We're not just being watched by foreign capital. Foreign capital is watching us and making a decision, and I can certainly point at foreign capital that has made the decision that Australia is too hard to transact in and has gone to other countries. Which country at the moment is attracting foreign capital more than we are, or that would have come to us? Well, I can say there's one source of capital that probably would have deployed somewhere between 200 and 500 mil into Australia, which has gone to Peru. Chile. Chile is very, very investor friendly. And so that's the immediate one. What's the next one? From a grains perspective, Kazakhstan and the broader Central Asian states are very aggressive and are lining up. I wouldn't invest there today, but within 2 to 5 years, Kazakhstan is on the radar. In Kazakhstan, the government gives qualified investors like special diplomatic corps number plates, so they get to park in funny places and don't get done for speeding or whatever. But the point is, that is a government, as are Chile and other areas of the world, that are hungry for foreign capital, and are actively putting measures in place to facilitate, to attract that capital, rather than putting a bit of a muddy environment, which is what the Australian environment currently is. Michael.
Thank you. I'm going to stand up here for a sec because I'm just conscious maybe some people here can't see through the lectern. We have about 20 minutes left in this session officially. I should say, are there any questions from the floor? Does anybody have any questions for Phil or Adrian or myself? While we do. Cool, thank you. Do we have a microphone down the back, please?
Thank you. Brett Stevenson from AGIC. I unfortunately just rolled in here at the halfway mark probably of presentations, but we're 10 years away from deregulation, so it's pretty early days for us compared to a very open market economy in America when you think about the risk management side that you were talking about. But we're going into the shortest stock situation probably ever in Australia for grain here as we speak. Do you think it's just an evolutionary thing to do with the risk management? Because, we notice a lot of consumers in Australia just don't manage risk, they just buy the grain. But it was only 10 years ago they could ring the AWB and buy the grain anyway. So maybe it's just early days. I'm just wondering what your views are on that.
Sure. I think we were well on our way with a fairly good ASX wheat contract. Obviously, with the demise of one of the trade houses or banks, it left everyone in a fairly precarious position, and I think it left people with a fairly bad experience. So I think the demise of the ASX futures contract was a fairly significant disaster for the sector. It really has removed a lot of those hedging capabilities. As a trader, or those compared to trade houses, there's a fine balance. Most trade houses want hedging tools and the like, but they also do want a little bit of opaqueness. It's, to be blunt, it's how money is made between farm gate and export. And so in terms of reporting information, transparency, that provides the best outcome for the industry as a whole, not necessarily for all participants at all times. But I think the banks have also been forced to pull back in terms of their market making in the same way. It's much more challenging to hedge off against Chicago or Kansas or French wheat if we're talking about grain in particular. So I think we've gone backwards in the last 5 years. The first 3 or 4 years after deregulation, there were some pretty good tools and the like. We've gone backwards as an industry. But I think in the end, it's in everyone's long-term interest. For the trade houses alone that lost a lot of money in 2015 and 16, a lack of hedging tool was one of the issues. So we all have to take massive amounts of basis risk to make markets in Australia. It creates massively wide pricing for farmers in terms of the hedge they're going to get, the implied finance. It makes us less efficient. There's huge slippage for us as an industry to be as efficient as we can. And so I think an easy solution is a futures contract that makes sense and that is liquid, but to be blunt, the behaviour of the ASX was less than to be desired at the time, and it's left us all in a position of saying, well, we'll just get on with it and make do. But
question over here.
Todd Lees, Latima Brokerage. Question for Philip. Just curious why Peru is a more selective destination for investment than Australia. If you could be a little bit more specific, why they chose to go to Peru, and then Kazakhstan possibly.
Yeah, Chile, not Peru. That was my mistake, but Chile, yeah. I haven't been to Chile, but I just know that a couple of significant large investors who were looking here, and very aggressively, I think people that Michael knows as well, and it was it wasn't Fifth Avenue, but it was that part of the world. They had looked very closely here. They had made a couple of small co-investments, along with everybody else on almond orchards on the Murray and the Murrumbidgee, with a view to growing those investments out. But basically, the phrase is landing in Sydney at 6 in the morning, it's like landing in treacle. And that the macro of Australia is brilliant. But when you actually get to that transactional side, that's the bit that's like treacle. And the opportunities are definitely here. I mean, I'm incredibly bullish about ag in Australia. I'm not saying that we've missed opportunities. I'm saying that there are opportunities to be taken. Chile as a government basically is putting the shackle out there and saying, invest in Chile. And that alone attracts capital that is fundamentally averse to anything remotely that looks like political sovereign risk. And when you're tinkering permanently with the Foreign Investment Review Board, or not the Foreign Investment Review Board itself, but the regulations, and the worst one, you must advertise everything over 15 mil, which was roundly in the global sort of ag community, in the global ag media, was referred to as the blunder from down under, which essentially, I mean, that 15 mil net catches what? Mid-sized farmers who want to exit. So they, basically have to advertise, they have to, and we all know what it's like, the Weekly Times, the Land newspaper, Queensland Country Life, the advertising pages in those newspapers are the rural gossip columns. And I certainly, in the same way that I'm familiar with, a big wad of cash from Chicago that would have come to Australia but it's now gone to Chile, I'm also very familiar and aware of a number of farming families in New South Wales and Victoria that should have sold or should be in the process of selling, but have put their head firmly in the sand because they don't want to basically air the laundry in public. So why is Chile so good? Well, fundamentally, agriculturally, they're extremely innovative, as are we. Obviously, one of the core staples out of Chile, as well as numerous horticultures, is the avocado, and the avocado is one of the darlings, along with next on from almonds of the investment world. But coming back to Michael's comment about vertical farming and fake meat or 3D printed fake meat, there was always this passion and desire to get into something that is new and innovative. Now, how long those investment windows last for is another debate. You'll be in a wheat investment or a cotton investment, even a livestock investment, a lot longer than you will be in vertical farming. It's private equity, it's get in, make your money, get out. But fundamentally, why is Chile attractive? Because the government wants the capital, investment capital, and it will bend over backwards to attract it. Well, if you're looking at US capital, typically what they will do, and let's just sort of use the avocado because it's one of the darlings of our, or actually for that matter, any commodity. What the US will do, a US investor sitting in Chicago or New York, is he will work out what return can I get for that commodity in the US? Okay, so can I get 10% on avocados in California? Yes, I can, fantastic. Then he will start loading on risk and distance effectively. A few points for every negative that he sees, and realistically, if you're on 10% in California avocados, to come to Australia, you're going to have to see 14–15%, and that maybe that's 2% to get it across the Pacific, and then 2% because it's Australia. That's essentially how they work. And Kazakhstan, just for that one, I was there a few months ago. Look, it's the Wild West, but when they sort themselves out, which they will. It will be a powerhouse supplier. If you look at Kazakhstan, you've got Russia to your north, you've got Western China to your east, you've got the Indian subcontinent to your south, before you even think about Eastern and Western Europe to your west. It's a pretty interesting place. And these are the things that we've got to compete with. And these developing countries, you have to remember, why does a place like Kazakhstan have a better mobile reception and better connectivity than Australia does, or for that matter, the UK or the US? It's because they never had landline, and therefore they were never strung up with outdated old infrastructure. It's the same as look at Ukraine versus Germany. Germany's got some really great ports, but they're really old and they're not terribly efficient, whereas Ukraine's just got new stuff.
Thank you. More question over here.
My name is Angus Thornton from ProFarm Australia. Can you hear me all right? Sorry. Yeah, just referring to Adrian's opening comments about money being cheap but perhaps not readily available. This question is, I suppose, based on the premise that is contained in that statement that debt funding remains a cheaper source of funding than equity funding. I mean, assuming that Mike might be able to put some light on this, but assuming that banks and other more traditional lenders will still have some appetite for agri transactions, and the presence of, say, Rabobank here, who are a food and agriculture only bank, suggests there will be debt funding available in Australia for agriculture. So with debt funding being cheaper, presumably that still attracts the lower risk, if you want to say, sort of better type borrower to the banks, and then perhaps, maybe I could be wrong here, but then if the better type of lower risk borrower is going to the banks, perhaps does that put the higher risk sort of type of borrower or finance sourcer in the equity or the capital markets? And I suppose, does that sort of exposure to maybe the higher risk agricultural producers, is that sort of one area that the more equity, non-traditional sort of forms of financing for agriculture needs to address? And maybe does the equity sector, what could they be doing to maybe be attracting your sort of lower risk clients away from the traditional debt providers?
Sure, I'll give that a crack. Is an almond grower that's producing a lot of cash today a lot lower risk than a dairy farmer that's not producing any? And the point of that statement is each part of the ag sector has its time in the sun, and I think that's a massive generalisation, but I think it's fairly true for the industry as a whole. Even the lowest cost producers struggle when the commodity prices fall dramatically, vice versa. When we've got super high prices, everyone looks like a champion. So I think at the heart of it, it's looking at the source of lending. When it comes from a highly leveraged deposit-taking institution, they have to be very balanced about how they approach it. They have to have a lot of buffer, because otherwise a borrower quickly moves into a bad bank. They struggle to deal with them in the bad bank because the banks, to their credit, are really not tipping many farmers up. They're they're staying the course and trying to be there and support them, but they can't provide more credit when times are tough. So I think for us, it's less about high risk, low risk. It's actually more about taking a view on the cycle and lending money to a dairy farmer when things are really tough and land values have been somewhat depressed or cattle prices somewhat depressed seems like a better lend to us than lending to a highly cash flow generative commodity producing farmer when we're at the top of the cycle. And so I think that's at the heart of where we see the opportunity for lots of people that want to get involved in the ag sector. There's the chance to provide equity as debt. You're not necessarily taking on the operational risk. You don't want to be responsible for employing the manager, but you want to participate. You have a view that things are going to turn. And so that's one area of opportunity. And obviously I have a view and sort of a bias in sort of describing things in that way. But I think that's at the heart of it, that there's a need. That credit expansion in our economy for 25 years has been relatively unabated. That has ended. The regulator's telling us it's ended. The nature of banking is telling us it's ended. Interest rates at 1.5% tell us it's ended. For the next 25 years, we need to find a different way to support the sector, and that is the provision of capital from equity providers such as super funds that say, I don't really want to run farms, everyone tells me how hard it is, but I want to participate in the food price. Maybe I'll lend money, get a little bit of participation, I'll do something different. But it's not necessarily, I don't think risk is defined by the company that's making a lot of cash today, because we all know that disappears pretty quickly in our space.
Further questions? Actually, I'm going to step on from that one as well, and I'm going to milk some information out of these two and then rush it back to Collins Street and put it in the bank strategy. If you are talking about a landscape that we have here at the moment, where we have those sources of alternative capital, but by and large traditional debt funding as well, do some future planning. In 5 or 10 years from now, banks are going to employ half the people. We will have been replaced by algorithms. We will have specialised in what we do. But we will still be doing a lot of the traditional side of business as well. But with the sheer scale of liquidity in the market at the moment, whether it is at that medium level wealth up to the Canadian pension funds, wherever it may be, that is going to be present in the market. Where do you see the agricultural capital availability, if we can put it like that, in say 5 years from now? And the second part of that is, and it goes to one of Phil's points as well, everybody in this room is a fantastic farmer, but some of their neighbours aren't. Where does everybody in this room who is hearing everything you and me and others say about these great new sources of capital or these great ways of approaching it or becoming involved in it, at which point or how do they become part of what's going to be there in 5 years?
I think a great question / statement from Michael. I think the last point of your comment is actually one of the most interesting. And that is, yes, everybody in this room is a great grain farmers. I'm a great super farm wool grower from northern New South Wales. And of course, none of us are any bad, but there are lots of bad farmers out there. I think that the capital markets, the sophisticated investors, North America, Canadian or American, European, more out of North America at the moment than out of Europe. I think the cleverer guys are starting to work out that farming is a people business and it's about people, not about farms. And I think that you will increasingly see a focus on not the farm, on the farm management and on the capacity of those individuals to generate return. A farm, I have yet to find or see a farm that makes money. Farmers do. And I think that a lot of people, that the sophisticated capital is starting to work that out, as opposed to that, a cotton farm will make me 8%. No, it won't. The guys working that cotton farm might spit out a yield of about 8%. And I think that's where you will see capital deploying increasingly alongside operators who can prove, and again, this is very different from the traditional ways of selling farms, which is real estate. If you want to attract capital, you have to take your clothes off and you have to prove down to the finest detail what you can do.
Practically, and I know we're running out of time, practically, how does that happen? There's Spence Millier sitting over there who, running a great operation around Lake Bolac, and you think, I'm a fantastic grower. I've heard about these sources of capital, but nobody's knocking on my door.
Oh, I can tell you how it happens. I mean, I'm not going to go into the sort of pitch about come and see us or whatever. It's quite simple. You have complete transparency. And it's not done, charts and diagrams on PowerPoint presentations. It is, you will have a number of calls, then everybody has comfort, you visit the farm, as in the capital providers, and then it is in the farmhouse, it is in the farm office. You have the guys from New York or Washington or wherever who should know what they're talking about, but might not have the hands-on experience, and they're going through every financial record, and the farm accountant and the farm office manager is there giving complete transparency. That's how it works. And as soon as, if you're going for a joint venture, and as soon as the incoming joint venture partner feels that information is being withheld, that's not much of a joint venture. Adrian.
Yeah, I think we'll see a lot more funds emerge in Australia in the credit space, and I think some of them will be logistics, some of them will offer ag, some will be general. Unlike having spent a decade in the US working for Merrill Lynch, which is all about Main Street to Wall Street, it's bringing credit to the masses. It doesn't exist in Australia for a whole range of reasons, negative gearing, franking credits that don't drive credit investment, but as returns get a little tougher, if we're at the end of a long cycle with interest rates falling, I think a lot more people, as we sort of age, are going to be looking for income stream. Agriculture is going to be one of those things offered, whether it be us or many others, and I think there will be solutions because the returns will attract capital, and the simplicity of those returns will attract capital, not having to run the whole piece, because we're talking about both ends of the spectrum. It's all about management. Well, if you don't have the capability to run things well, which most companies don't, then getting a lesser return but participating through provision of capital in other ways is going to be very attractive to people as they're looking for lower risk returns.
I think moving forward, as we touched on there, is agriculture is essentially generating real return off a real asset. It's not sort of, this piece of paper is worth $500 million because it's a Barrett. No, it's not, it's a piece of paper. Whereas it's fundamental real assets generating real return.
Okay, last question, and just the one that I sort of put out there before. 10 years from now, 10 years in the future, what are we, 2028? In terms of accessing capital, financing for your 3,000 hectares of wheat at Brim, will you still be going to ANZ? Will you still be dealing with them, or I gather there are other banks out there? Or will the whole financing landscape be quite different? And will you, Adrian, you, Phil, or other points out there be the first port of call?
Some might describe the situation that you post your inventory, which has got some sort of tagging on it, and you post it to the blockchain, and someone picks it up and lends you money from Alibaba. I mean, that's some people portray that. I'm not sure in terms of property law. It all comes down to property law and entitlement. It's the security. Everything we spend so much time doing, no matter what investment you look at, it's ownership, security, title. If that shifts and changes in ag, and we have seen a lot of technology being worked on in terms of tracking inventory, tracking product, etc. If that changes quite dramatically, I think there'll be all sorts of solutions which will be on the click of your phone.
Joel referred to ANZ's report, Greener Pastures, which you crowed about because you said you wrote. I thought it was Angus Taylor who wrote it.
I'm going to tell Joel that later.
Okay. At the end of the day, what Greener Pastures said is that the industry, agricultural industry, is massively undercapitalised. And so there is a requirement, as Joel pointed out, to attract foreign and other forms of non-traditional capital. And as we've always discussed, banks have got to an extent, deleverage as that capital comes in. And so the banks probably have to find other ways of making money than simply lending money. But are they going to go away? Nah, of course not. They'll be here forever. Are they going to have the same level of exposure to agriculture in this country than is there at present? One would hope not.
A wonderfully controversial way to finish this on. Thank you very much to everybody here for your questions, participation. Please thank
you.
Phil and Adrian.